Hello, and thank you for joining us this afternoon. Let me continue with this presentation. This presentation has to do with some of the issues associated with our quarterly market perspective here. I noticed that this typo right at the top of the page is the Q2 market perspective. Anyway, I'm pretty sure you all knew that as well. At the beginning of the year, what did it look like at the beginning of 2017? Taking us back, there were a lot of anxious investors. Many advisors may have thought that their clients wanted to exit the market. The market was at historical highs, as you know. We had a new president, a controversial and an experienced one, as they always are, of course, when they're new. Contentious European elections loomed on the horizon, and there were lots of terrorism and terrible things that were happening. It was an unfamiliar investment environment for even experienced people because there was continuing domestic partisan turmoil. We have a terribly angry electorate even today, and I don't think it's changed really. There's been, on the investing side, there was low interest rates, bond bull market quoted, forecast to end pretty soon, and of course we have this $4.5 trillion Federal Reserve debt that is something important for managing the economy going forward. And finally, I think investors had this very creepy, strange idea of an eerie calm. There was historic low volatility. The VIX was at historical lows, and the average daily swing was the lowest in more than half a century. So you weren't crazy when you thought the market was not volatile. It really wasn't volatile at all. Okay? And finally, there's always been something of a fear of the unknown. The Federal Reserve, of course, has these governors are experts in macroeconomics. But this was all an untried idea. It came from the Depression and some wonderful econometricians that put together the idea of modern macroeconomics. What we have been using is monetary macroeconomics, and it was the only policy available because, unfortunately, political partisanship did not allow for us to use a fiscal monetary policy, which is far more powerful leg of the macroeconomic theory. So we've had a tortuous 8-year economic healing process, and that's where we were at the beginning of the year. People were concerned. So what happened? Third longest economic expansion since 1850. It's been a time for regrets. Second longest bull market in modern market history. Global stocks, one of the strongest half years for quite a long time. Only 4 of the 30 major indices didn't have positive returns. We have a lot of improving economies around the world, coordinated global central bank, rising Eurozone consumer sentiment. It's really been a real revelation in how things are starting to change in the Eurozone. Lots of strong earnings growth here in the United States, and vigorous tech industry here in the United States and China. So if you left the market, you probably are crying in your beer, okay? Now what about the current issues here? Well, domestically, how do the economists think? The mainstream economists have something of a serious consensus. The working economists in the street, as they call them, not the pundits. The economy is experiencing slow, robust growth. There's still low unemployment, amazingly low employment, although it's not full employment. There's been steady job growth and wages as well as numbers, very low inflation. And the Fed, as I'm sure everybody knows, is on course to normalization. And it's not just these very small quantum point rises in short-term rates. It's also very, very importantly the beginning of the process of bringing down the Fed's debt. And that's scheduled to be discussed in September. What about the Eurozone? I've been absolutely amazed that there's lots of encouraging political and economic news in the Eurozone. First of all, this Mario Draghi program, he truly is a genius of macroeconomics. It's all but getting traction. Of course, there's an enormous amount of money being poured into the economies, of course. It's not magic. It's real finance. But there's progress on the economic side for the Eurozone, progress, and even in Greece. The major Eurozone indices have been positive in this quarter, in this half year, and mostly the French election has really changed the kind of sentiment in Eurozone politics, and the prospect of political normalization seems to be real. And that is a big change from what it was at the beginning of the year. China and Japan. Well, China has managed to keep their currency pretty stable. They've been pouring a lot of money into it, but they've also regulated capital controls. So the renminbi seems to be pretty stable compared to what it was, or worried how people were worried about it. And Vitaly just said something about the MSCI Emerging Market Index. It will now use mainland stocks in 2018. It's a very small amount of actual investing, but it is an indicator of the slowly maturing Chinese capital markets. But make no mistake, this is a big deal. We heard just this morning that 29 ETFs will be affected by this change in MSCI's policy of how to use Chinese stocks. So all of this is a pretty serious thing, but it also has to do with the slowly maturing Chinese capital markets. Debt, however, as every economist will tell you, China still is dogged by an enormous amount of debt, and it's a big risk factor, and it's not going away anytime soon. In Japan, amazingly, there's a little bit of encouraging news in terms of at least possibly a short-term, but at least a tempering of bond-buying stimulus process. The Financial Times was talking about the fact that Abe might not have that much room to do all of the things he wanted to do, and there might be some cutback on the stimulus process. Anyway, better returns in the quarter, as Vitaly said, and there are lots of headwinds, but the government seems to be on station. Okay, and globally, just to think about it a little bit more than just simply individual economies, there's a lot, the central bank policies have been largely coordinated, certainly working together. And so they're thinking about it. Of course, like I said, it's not magic. Trillions of dollars have been injected into the major economies to promote growth worldwide. But the investors have greatly benefited. The markets seem to be performing according to what seem to be reasonable things to expect of it. Low oil prices, of course, is a little bit of something different to think about, but it also is beneficial to the global economy. A very robust tech sector here in the United States and China and other parts of emerging markets as well. So the economic factors globally are in pretty good shape. Low interest rates, low inflation rates, and of course, going back to one of the strangest things of all, very low volatility in many capital markets. So let's go to some of the investing issues here. It's been a great 2 quarters. It's been a great period of time, actually, for investing. But how do people feel about the world now? Well, hopefully they don't feel the same way as they did in January, but who knows? But there's a continuing concern about low volatility, and it's one of the themes of the pundits and so on. What's going on here? Are investors totally complacent? Are they just not paying attention to things? Our markets are on a sugar high, and it's all going to come crumbling down here shortly. How come markets don't seem to be concerned at all about political uncertainty? Is it just complacency, or what's going on here? Okay, so there's plenty of questions to ask here. And then the Fed normalization program, it seems to be in really good order, run by some wonderful virtuosos of macroeconomics theory. But once it picks up steam, what's the baseline? Where does the economy then end where the interest rates, long-term interest rates in. My guess is not any better than yours. What's the baseline is an interesting question. And while the European Central Bank has been just doing an amazing job of trying to manage the Eurozone economy, investors are very trigger sensitive to any changes in these Draghi policies. As I'm sure all of you know, is that the markets got spooked for a couple of days when he was misunderstood, or maybe he wasn't, but who knows. The alternative to all of this is that why is it that nothing seems to matter? Okay, well, maybe market's robustness is because it's rational, it's going to continue, and then maybe the central bank policies have been far more effective. Modern macroeconomic policies have been much more effective and much more than anyone could have expected. So it's an interesting time for trying to make some sense of all of this world. And of course, as investors, we try to do, as you do, the best possible understanding with all of the uncertainty associated with it. So what about America? The American economy is the linchpin of global economic growth. It has been stable. It seems like it's stable, robust, slow growth is what we're going to live with for some time to come. There was a lot of hope for the Trump effect and the Trump policies, but that is certainly diminished, if not disappeared. There's no question about it. The major American economic risk is political. There is this national identity anger that is isolated not isolated, but characterized by the Trump base, and has nothing to do with Clinton investors at all, or Clinton voters, I should say. It's really fundamentally what is there, and it's not going away. And of course, Russian meddling is an ongoing concern. If anybody's been reading the newspapers today, has a lot of things to read about and know about. The administration's lack of focus on these nonpartisan issues is really a terrible shame, because there is consensus on the need for infrastructure spending, for real tax reform, real immigration reform, and real regulatory reforms, but your guess is, again, as good as mine of whether any of this is going to happen. Globally, however, the world is possibly a more positive space. The politics of austerity in the Eurozone seems to have died, okay? I don't think there's really an argument anymore of how to use macroeconomic theory. The Eurozone is in positive signs of growth. The markets have been positive. The French elections have stabilized the politics. The Eurozone seems to be very safe, regardless of what Brexit does or doesn't do. The Chinese government is well aware of its over-leveraged debt issues. Hopefully they'll be able to do and keep this renminbi stable. And there's modest positive news from Japan. It's very modest, but there is some positive news. There's no question about that there's still geopolitical risk associated with religious and political terrorism, the Middle East, military confrontations, hopefully in North Korea or North Korea, whatever. State-sponsored cyber attacks, that is a looming risk that could explode, but hopefully it will not happen, and hopefully will not cripple economic growth. So at the end of these commentaries, I always like to bring something into the discussion that is more of a long-term issue here. And so I'll call this passive versus intelligent investing. And I'll ask a question that I think is awfully important and awfully topical currently. Are index funds actually efficient? Why passive investing? It's a professional and academic consensus that index fund investing is best for a majority of investors. So what are we doing here? All of us on this call, what are we doing, okay? If index fund investing is best for the majority of investors, then maybe, what kind of business do we have? Well, there were two arguments. The first argument is a very practical one. It's just a better deal, okay? Active strategies charge more and perform less well on average over time. And while it's not always true, it certainly is often true. And it's often true for strategies that did well last year but don't do well this year. Okay. And then there's something even, in some ways, just as important, if not more so. 20th century finance theory says that the market portfolio, not the market itself now, but the market portfolio is efficient. And the way to invest, if you take a good MBA course and that kind of thing, a CFA course, well, maybe not the CFA, but a good MBA academic course, you invest in a combination of the market portfolio and a low-risk asset, and that's all you need to do, okay? And so that's financial theory, and that's practical theory, and it really is a compelling case for index fund investing for nearly all investors, maybe not experienced investors, but nearly all. That's the status in the background here of our business. But let's take a closer look. There's an important critique that many of you may not be aware of, okay? Dr. Harry Markowitz, who is nothing more than the founder of modern finance, has a paper, actually he has 3 papers, but has a paper that says the market portfolio is not mean variance efficient. Well, what does that mean? The market portfolio is not mean variance efficient? Well, how could the market not be efficient? What does that mean? Does Markowitz theory make investment sense? So I've been thinking about this, and I've known about Markowitz's result for quite a long time. We discussed this here in the company a lot. Let's go back to something basic. How are securities priced? Well, they're priced on earnings. They're priced on book value, maybe. Some people like earnings, some might feel like book value. Some people like discounted cash flow models. Some people like sales, some people like earnings growth, those are the growth stock managers. Some people like income, some people like momentum, some people have short horizons, some people have long horizons, some have different levels of risk aversion. All of these factors affect how securities are priced. So what's an index fund? An index fund is a mixture of all these things. And investor views of security pricing necessarily have to be canceling out, because what you end up with in the market is not anything at all, not a discounted cash flow, not a dividend discount, not a book value. So when Markowitz says that the market portfolio is not mean variance efficient, what that means is that an index fund is not an efficient investment. And that thing is something of a big surprise to a lot of people, and I think an important thing for the business that we all share. Okay? So index funds still have a low fee advantage over active funds. Okay, it may be a no investment information product. Maybe it's just nothing more than a committee's view of how to manage the stock market, but it often beats active management fees. So how do we rationalize this persistent outperformance that the academics claim seems to be there? Are markets perfectly efficient? Well, raise your hand if you believe that. I'll bet there aren't many hands raised. Being informed doesn't help? Wait a second now, does that make any sense? How come being informed doesn't help? Because these are no information products. Okay, well, is finance irrational? Or could there be other reasons? And again, I think this is something I think is worthwhile paying some attention to. Let's think about other fields. And one of them that came was across my mind was medical practice the last 30 years. Medicine is really advanced in many, many ways. It may be more expensive, but there are many, many advanced technologies. And my list is a short version of a long, long list of MRIs, ultrasound, laser treatments, many, many kinds of things. And that's, for the last 30 years, medicine has improved tremendously. What about investing technology? I submit there's not been any serious fundamental changes in investment technology since the 1970s. I'm not talking about derivatives, I'm not talking about options, I'm not talking about swaps, I'm talking about plain old ordinary investing, the kind of investing that we all do together, okay? This may go a long way to explain why there's no evidence of persistent outperformance beyond randomness. Well, that's not New Frontier. New Frontier has 21st century innovations that are significant innovations. We have the patented Michaud portfolio optimizer. We have a multi-patented Michaud rebalancing technology, all very, very fundamental to, I think, our success as asset managers. We don't choose index funds, even though we have them in our portfolio, because they're mean variance efficient. They are just simply placeholders or diversified funds that represent global risk premiums. That's why we use ETFs. We don't think of them as efficient. They're just placeholders for the risk premiums. And then we put them together in a strategy, and that makes our strategies efficient, not because the index ETFs are efficient, but because the portfolio of the ETFs that we invest in and our strategies are mean variance efficient.